Hi everyone, welcome to the JJ View, your go-to spot for fascinating chats with amazing Chinese American minds. As we reflect on the whirlwind of 2023, new world orders, monetary system resets, and China's post-pandemic maneuvers, brace yourselves for an enlightening journey into 2024. Today, I'm very thrilled to have a seasoned expert, a true luminary in the US-China markets, my friend James Early. With a wealth of experience, James is our guide through the intricacies of these markets, a real maestro in decoding mysteries and, who knows, perhaps sharing some invaluable investment insights. James, a warm welcome to the show.
Thank you, Ja. I don't know if so many adjectives have ever been used to describe me, but thank you. I'll strive to be an amazing Chinese American mind, at least for this show.
Yeah, I have to say that James is also a Chief Investment Officer at BBAE, a digital investment platform. What a roller coaster for 2023, right? So we've seen regional banks doing a little shuffle in March now as we strut into 2024. So spill the tea, James. Is the dust finally settling on the regional banks in the U.S.?
I don't think so. I don't think so for two reasons. First, if we step back, John, the U.S. Had almost 15,000 banks in the early 1980s. Now it has about 4,600, but that's still way more than many other countries. China has just a few hundred. Japan just has a few hundred. The UK just has a few hundred. We have a whole bunch of banks, and that's weird because banking is an economy of scale business. And the reason the U.S. has so many banks is that the government long ago said, we want to protect farm lending. We're worried that if every farmer in Minnesota or Iowa or Nebraska has to go to New York City to get a bank loan, those city people are not going to relate to the farmers and it's going to hurt farming. So they said deliberately, let's protect all these small banks. The problem is that's fighting the tide. It's not the natural evolution of the system. We still give small banks a lot of free passes or breaks. They do have higher returns on assets, studies have shown, compared to larger banks, but they're much more play on the yield curve. Whereas larger banks have investment banking, they have a lot of different fee income, they have sales and trading. Small banks are just banks. They generally receive money at the long end of the yield curve, and they lend it out the short end, right? And that's how they make their money. So, and they're also much more tied to domestic businesses. So basically, as the domestic U.S. economy goes, so goes the small banks. But the general pattern, the tide is kind of moving away from these smaller and regional banks and towards those big money center banks.
That's very good to know. But I want to dive a little bit deeper into the economic landscape. Actually, Stanford University has a import. I think it's very interesting. So there is a 2.2 trillion worth of assets in the U.S. banking system, apparently called playing hide and seek between book and market values. So the stakes are high. A run on banks in the spring of 2023 at Silicon Valley Bank, Signature Bank, and First Republic. So this drama really triggers concerns about the liquidation values falling short of covering both insured and uninsured deposits. What's your take on this precarious balancing act?
Okay, so we're talking about an accounting issue here, technically. It's not going to be a problem if rates are falling. It was a big problem when rates rose. It's held to maturity accounting. In other words, Silicon Valley Bank and other banks can buy assets, can buy bonds, let's say, and say we're going to hold them to maturity, in which case they record those asset values at original amortized cost on their books. And across the U.S., about 23% of U.S. banks' portfolios are in held to maturity assets. It's not a problem as long as interest rates don't do anything crazy. But when interest rates go way up quickly, suddenly the value of those bonds that are paying, in this case, Silicon Valley Bank had basically risk-free bonds. It had very high credit-worthy customers, and it was operating in an economic boom, or at least in a very good time, which is totally antithesis of when bank failures are supposed to happen. The regulatory system in the U.S. is based around the presumption that bank failures happen during bad times and because of bad credit. That's not at all what happened here. We had an accounting problem where there were accountings for stuff at held to maturity, means original amortized cost, not mark to market. So when rates go up, if you hold bonds that pay low rates, even if they're treasury bonds, right? There's no credit risk in U.S. treasury bonds, but they pay low rates. Nobody's going to want to buy your old bonds, right? Because new bonds pay more. And so you have to mark down the value of those bonds if you're marking to market. But they weren't marking to market. They were holding to maturity. and not just them, a lot of other places. And so, like, that makes the whole system vulnerable. So the Stanford report you mentioned, if that, I think that's what it's talking about, it is structurally right. I don't think it's going to be a risk as long as rates are falling. Okay, because that's not going to bring up that valuation discrepancy, and rates are about to start falling in 2024. I think the real solution, well, two solutions here. First is assets and liabilities should be marked to market. There should be no way to hold to maturity. You can footnote it if you're a bank and say, okay, we intend to hold this to maturity, but we're marking to market on our real statements. Like, that's the better, healthier way to do that. The other more controversial thing I'll say, Jia, is there's an argument that all deposits should be held at the Fed, all bank deposits. The Fed is ultimately going to be involved in backstopping those deposits, as has been the case so far, I should say. So I'm sure the banks would absolutely hate me saying that because they make a lot of money on those deposits, but I don't think it's a crazy idea.
That's very interesting, and I have to mention that right now, if you look at Bloomberg, CNBC, like all the major news in the U.S., and they talk a lot about private credit lending, and that has just become the new favorite for Wall Street, and suddenly private credit lending became this cool kid at a party, right? So why suddenly private credit lending generates so much traction?
Well, I would frame it like this. I would say private markets writ large are kind of the new public markets, meaning it's the same thing happening in private equity. You've got Republic.com, WeFunder, you've got a bunch of these crowdsourcing equity platforms on one hand for the retail market. And just generally in private equity, companies are staying private longer rather than going public. We have a pretty steep decline in the number of publicly traded companies in the US because companies say, why do I want to bother going public, right? There's nothing wrong with private debt. They can be more bespoke. They can tailor the needs specifically to each business. Like somebody may need mezzanine financing, somebody else may need something else. So private credit is really a broad catch-all term. There's nothing new or innovative about it per se. It's just become more popular these days. There's a weakness though. There's a weakness, which is it's harder to, you need to find just the right buyer when you want to sell that private credit. Like, it's sold person to person, it's not sold on an exchange. And that's why the intermediaries love it, because that kind of thing has higher margins, right? So they like higher margins compared to like stock trading with a security, the margins are a lot lower. So, if I'm an investment bank, I like private credit because I can go and call up my wealthy clients and sell them investment opportunities and probably make a much nicer spread than if I'm selling them a publicly traded bond or a publicly traded stock. So we're hearing about it. Yes, nothing new or innovative per se about it. It's just become more popular.
I want to dive into the crypto roller coaster, James. For 2023, we've seen a lot happened for the sector, right? So we see SBF took a tumble, and the SEC threw the rulebook at Binance and Coinbase. But hold on, Bitcoin is out here still flexing its resilience, right? So James, are you riding the Bitcoin wave, and any plan to add more in your portfolio 2024?
I am mostly not. In fair disclosure, I bought a couple of years ago a little bit of Bitcoin when it was like $19,000. So technically I'm up on that, but it was really just a test. I was just playing around. I'm not as far as Jamie Dimon, JP Morgan's CEO, who says basically it has no use. And then he came back and said, oh, it does have some use, paying for sex workers and hostage, extortion scams, things like that. So he's very bearish, as is Warren Buffett and as was Charlie Munger. Economics is a social science. And if people get together and decide something has value, it will have value, whether it's a pet rock, whether it's gold, whether it's a piece of artwork, whether it's a stock, whatever, right? Everything, there's no such thing as a real absolute fixed value. It's all in the eye of the beholder. And Bitcoin and crypto at large has been a fascinating case study in that. I mean, people forget these are supposed to be cryptocurrencies, right? And currencies in the real world, like between US and China or Peru and England or France, they go up and down based on balances of trade, based on faith in the economy, based on interest rates and the relative things like that, right? Economic terms. These are currencies, but they're being treated as speculative assets, meaning people say, well, I have no idea why XYZ token is supposed to go up, but I'm going to buy it because it's going up. And like not everybody is buying crypto for that reason, but like 90 something percent of the money buying crypto is buying it either for that reason or saying, okay, well, these, stupid retail investors are buying for these reasons. I think it's stupid, but I'm still going to jump ahead of them and try to, or pile on and try to capture that wave. So that's unhealthy. You have a lot of really unhealthy speculation in cryptocurrencies. So I have not added anything more to my Bitcoin. I don't plan to. I'm not going to say crypto is all garbage. It's all nonsense because it does have uses, especially for shady or sketchy emerging market countries who, for them, their own currency is even more volatile than a cryptocurrency. And so rather than the dollar, they might use something like a Bitcoin. But I mean, that's niche, especially once central bank digital currencies come out. I don't know where the dust is going to settle on crypto. I'm not saying it's all a scam, but there's a lot of scam. And ironically, it was started under this blockchain premise. Like, oh, we're going to use blockchain to make everything safe. You don't have to trust things anymore. You don't have to trust the government. You don't have to trust the private financial system. Everything's in the blockchain. It's immutable. It's totally trustworthy. It's been anything but that. Tons of scams, tons of frauds. As we saw SBF. I mean, last year was a mixed year. We had SBF, and then we had, or the last 1 year, trailing 1 year, then we had the ETFs, which had pretty huge demand. But the whole market cap of crypto is still like less than one big U.S. company. It's not as big as it seems.
Right. I'm glad that you mentioned CBDC. And actually, for the past year, we actually interviewed a lot of pundits and talking about CBDC. And, I would say the sentiment that we got from all these people was that CBDC was really precarious. It's all this type of control. It's from the top down. It's really about the banks or the Fed trying to control people's freedom. So people are really scared what's going to happen after CBDC really rolled out. And obviously, we have a fight now, right?
First of all, CBDCs are inevitable. They're going to happen whether you like them, you hate them, or you're in between. Okay, it's going to happen. It's just too convenient. As technology has grown, technology always gives more power to governments. It does. I mean, look in the U.S., speaking of Constitution, right? We have the Second Amendment to the Bill of Rights, the right to bear arms. That was made at a time when the U.S. had just rebelled against England. And so the idea of like the average person in the U.S. having access to a musket, which took, 2 or 3 minutes to load each shot, so they could rebel against an oppressive government, was fresh in the minds of the people who wrote that. But nowadays, it wouldn't make sense for an average person in the U.S. to bear arms, to bear weapons capable of overthrowing a government. I mean, do you want your neighbor having nuclear bombs or biological warfare? I mean, no, of course, right? So as technology has grown, we've said, look, we have to let the government alone have that power. We don't want, that power in the hands of the people. And whether you like it or not, that's just reality. And I would say the same thing with finance. It's just, the government is going to have more power with CBDCs. Yes, they can immediately change interest rate. Yes, they can immediately shut off your bank account if you're a bad guy or if they deem you to be a bad guy. And that's a big risk. I think that just needs to be matched with corresponding transparency. And I'm not dismissing the anti-CBDC argument. I think it is a real and it is a very valid concern. And the government needs to be very carefully monitored. The U.S. Constitution also says a government which is not constantly monitored and criticized by the people will become corrupt. And I believe that. So yes, I think it's here. I'm not that worried, but I think we really need to have a lot of scrutiny on it as well.
Well, that's very well said. It actually reminded me of what happened in China. People were saying actually China was the kind of really spearheaded this CBDC move, right? And talking about the digital yuan and what we've seen in China about WeChat, all the digital payment rollout. So, but when you talk about really about freedom and do Chinese people's freedom get compromised? I don't really believe so. I stayed in China and I would say WeChat gave me so much convenience. Nowadays, people, if you go there, you don't need cash anymore. So that's, how I feel about the overall convenience that digital currency brought to me.
Well, I would say this, John, that, if you are kind of in the mainstream, like an average person, those things are a convenience in China. And for me too, right? I spent a lot of time in China and I got to say, compared to Westerners, Chinese are much quicker to adapt new technologies, very fast, almost too fast. I mean, I remember years ago they would switch bank accounts every 2 weeks if when like Alibaba and some of the other ones were competing on rates and money market accounts. They switch again just to make slight improvements in 5.1%, 5.18%. Americans would never do that. We're just too lazy. And so Chinese are very good about that. So I think they deserve. They're an enduring people. I'll say that. The way the Western perspective on that is, yes, even if I'm in the 95% mainstream, it's fine. But what if I have a different view from the government, or what if I have a different opinion? Then suddenly, all those things are very, very oppressive. WeChat, where the government can see everything you're saying, knows all your friends, knows everything you're talking to people about. Your banking system is going to be monitored by the government more and more. They can shut you out. They can limit your access to certain train tickets or certain travel ability. Like Americans and the American value system, I think Western value system writ large, would find that to be oppressive, even though it's a small minority of the people who have views that might differ from the Chinese government. And that's by design because of the way the education is set up there. Like, if you're not in that group that just kind of goes along, then it's bad. But yeah, I agree with you. There are good things. And certainly if you're a legitimate bad guy in China, let's say you're killing people or doing crimes, it's much easier to catch you. There are positives to this surveillance state too.
Yeah, absolutely. And since we're on the topic already, I have to mention, now let's talk about China. So I would say you are really expert of China, and you did business in China for 10 years, and you're also a Kungfu master. So how was your Kungfu practice? Do you practice still?
I still technically not a master, but yeah, I've been doing it for 34 years now. Yeah, so it's just part of my life. I don't, it's just who I am. So I almost don't, I think about it, but I don't think about it in the sense. It's just when you do something for so long, it's just kind of how you are. So yeah, I loved it. I've practiced a little bit in China. And whenever I do, I get like this crowd of people around me, half of them videotaping, why go around, foreigner, look at this guy. Even though it's nothing special, it's just, an American guy doing Kungfu in China stands out.
Well, you should open a TikTok account.
You're right. It would probably be popular. I don't know if I want that fame, but I think you're right. It would get views.
Yeah. So, but on the flip side, we see the economic situation in the country is a little worrisome. Basically, China has already entered in this deflationary scenario. And today, Bloomberg has this article saying that the Chinese authorities are actually considering a package of measures to stabilize the slumping stock market. And they are seeking to mobilize about 2 trillion yuan, which is around 278 billion US dollars, mainly from the offshore accounts of Chinese state-owned enterprises, as a part of a stabilization fund to buy shares onshore through the Hong Kong exchange link. So what do you think about this news, and do you think that rescue measure will be effective to revive the Chinese stock market?
That's a good question. In fact, it's funny. I think in 2015, I got kicked off of Chinese state TV for talking about this because a very similar thing happened, right? The stock market was going down. As they said, that they had this big campaign, a little different than I guess, but they encouraged retail investors to open accounts, and it was going great. And then China didn't get included in the MSCI like as much as expected in the emerging market index, and so that was like kind of a small catalyst in June of 2015. And then they banned a lot of the state funds from selling, and they made the mutual funds buy up. What happened then, and probably what's going to happen now, is the domestic investors are very responsive to these programs. The foreign investors tend to run from the exits. And we saw the third quarter of 2023 was the first year, I think ever, since outflows and inflows were measured, that China had net foreign investment outflows, meaning more foreign investors took money out than put money in. It wasn't like by a huge amount, but it was something enough to technically tip it net negative. So I think that's what you're going to have more and more of in China, is this bifurcated system where the domestic people hear, believe, and respond to one set of stimuli and messages, and the foreign crowd takes a very different interpretation of that. So, and this is kind of what happens. I guess the English Chongyu would be, you make your bed and you'll lie in it, meaning the government specifically said, okay, we're going to blend government and private sector together. And so increasingly, you don't have the option of having just a vote for the private sector and a vote for the government. If a foreign investor is maybe not happy about the Chinese government, they think the economy is not being steered in the right direction, they'll pull their money out. And so, that's what we're seeing is perceptions of kind of a mixture of the actual like free market economic data in China. It's not really free market, but the market data and kind of the expectations, the belief. You see the increased scrutiny, like the rating of the foreign firms, detaining of foreign executives. It's really a lot of mixed messaging, I would say. There are also opening up programs. So there's good and there's bad, and it's kind of a jumble right now. And the foreigners are saying, yeah, just not for us.
Yeah, still on that note, obviously China has already entered into this deflationary scenario. So in a deflationary scenario, you're supposed to see the price of goods and service drop, right? But if you actually go to China, you still feel like everything is super expensive. So we haven't seen this drop yet of prices of goods and services. So why is that? And how about looking into 2024? Do you see where is Chinese economic headed for 2024?
Oh, okay, so on the deflation first, it's kind of like borderline minimal deflation. Depends on the number, depends on the month. So China is certainly not deeply in deflation. I mean, no question about that. It's kind of barely borderline in deflation. So it wouldn't. And remember, these are our aggregate indexes of a lot of different things. In some cities, housing prices are certainly in deflation. They're going down. But maybe gas prices are not yet. So it depends on the place, depends on the product or the service you're paying for. So we're probably not going to see that yet. Now, what we won't see, here's the danger, okay? And China in general has been reluctant. Like the U.S. sent people stimulus checks during COVID to stimulate the economy. U.S. economy is 68% consumer spending. China is about 52, 53%. So it's coming along, but not nearly as high. Chinese people have a 40 to 50% savings rate, at least the older people do. And that's deflationary. What I mean, and the government, here's why they won't send the check, because the people would just save it. They won't circulate that money. The velocity of money is very slow in China. And so they say, okay, here's $1,000, Mr. Wong or Mr. Zhang, whatever. And that guy's just going to save it, and that's not going into the economy. And once you have deflation, as Japan found out the hard way, it's very hard to climb out of it. It's a lot easier to fix inflation. You just jack up interest rates. Maybe you get them painfully high, but inflation comes down. With deflation, you can only lower rates to zero. I mean, I guess you can technically go negative, but if people are just afraid to borrow, they're not going to borrow. And so if they do get real bona fide deflation, which they don't have yet, then I think that's a big concern. I would say the real concern, though, is just faith in the future. From what I hear, it's just that seems to be on a downward trajectory in China. And you asked about 2024. Will it be a better year for the Chinese economy? I'd like to say yes, because believe it or not, I like China as a country. I have many friends there, have many wonderful experiences there. And obviously for thousands of years, it's made some of the greatest contributions to humanity. Many of the greatest inventions, I should say, the best craftsmanship. Right now it's not known for craftsmanship, but it was for much of its history. It used to be the richest country in the world for much of civilization's history. I see a problem. I mean, if you look at the Chinese economy, 24% of GDP is connected to real estate, 24, 25, something like that. And 30 to 40% of local government revenue has traditionally been received from selling or really like leasing for many years property in their zones. And local governments have a big financial burden. There are a lot of social services they need to provide. And this real estate game worked for the longest time because Chinese can't really send that much money out of China. They don't trust the stock market there. So they tend to mostly just buy a lot of real estate. I know a guy with 7 apartments before. But trees don't grow to the sky, meaning this real estate bubble looks like it's finally, and people have been saying it's going to burst for 15, 20 years now, but it may really happen. Just because it hasn't happened in the past 20 years doesn't mean it's never, ever going to happen either. So if we really see this massive deflation in real estate, we'll have a degradation of the net worth of Chinese individuals. B, we'll have job issues because a lot of the country is employed in building these huge apartment buildings and different and roads and things like that related. and also the local governments will suffer because they're already indebted massively. We don't really know how much, and they're dependent on this real estate for a lot of their revenue. Through they have these separate financing vehicles, but it's really for the local government. So, I mean, I'm not saying that bubble is going to burst in 2024. I mean, there's a graveyard of people who have wrongly predicted the demise of China, the Chinese economy, Chinese real estate. They've been saying it's going to blow up for years, and it hasn't. I mean, there are also people who've been saying China's going to overtake the U.S. in GDP for years. That also has not happened either. So, both sides have been wrong. I don't think it's necessarily going to blow up in 2024, but I don't see a big catalyst for any kind of improvement. If you look at all the overall things that define a healthy economy, ranging from demographics to GDP growth to credit quality, China's just not looking that great on those. So just purely as a numerical analyst kind of person for this question, I just don't see a case for a massive bull run in China next year or this year.
I mean, I have to say that I agree with you on that sentiment. And I have to say that growing up in China, obviously my generation, especially, we've seen the booming of the housing market in China. And it just went crazy from, for example, I came from Qingdao. It's a second tier city in China. It's it's not like a Beijing or Shanghai, but it's still a very well developed city in China. And we've seen that some real estate, some housing in Qingdao, it can be really super, super expensive depending on where you look at it, the location. So how can just the average Chinese young people, like late 20s, early 30s, how can they afford it, right? So it's really a disproportionate if you think about, the earnings that people make and their, affordability of the housing. So I would say, it's a little like distorted or twisted in terms of the, in terms of the pricing. And like you mentioned, it's not healthy to really rely on the real estate to prop up a country's economy. One extreme estimate that I recently saw was that China has about 3 billion like vacant houses, homes. So 3 billion, it's so what do you do with those 3 billion empty homes, right? So it's certainly a big issue, and I think it's also like deep rooted to sometimes like people's mindset, because you talked about the government officials and they are deeply indebted in this situation, but at the same time it's their way to really make themselves look good. If they have this sort of a housing project going on, that means they can bring more jobs, and that means they are really trying to help the local economy. So that makes them look good, on their resume. So this type of like mindset and behavior, it's not novelty in China. So I think there's so many factors really contribute to the kind of a collapse of the housing market.
Yeah, you're right. I mean, a lot of short-term thinking, and I would hope the 3 billion number is not accurate, because there's 1.4 billion people in China, right? But yeah, you never know, right? Because people are using these as speculation vehicles. You're right in the short term. These people, the short-term thinking, these officials say, hey, I'm going to be in office for 10 more years. What do I care about what happens in 20 or 25 years? I'm just going to build another road, even though we don't really need it. It gives more jobs, in my district right now. And that worked for 25, 30 years because China was uncoiling like this powerful spring, right? And you could almost do it. There are a lot of people in China who made a lot of money because they got lucky, not because they're smart. I'm sure you've met a lot of them too. And now the dust is really settling.
I feel like that happens everywhere.
It does. But U.S. has some of the same problem with housing, by the way. Like in California, some of these cities, a generation or two ago, the average housing price was like, 2 or 3 or 4 times like the average income. And now it's like 14 times the average income. And so it's kind of unmotivating if you're there saying, I'm just never going to be able to buy a house. I think that problem is on steroids in China. It's really extreme. And youth unemployment is so high, the government stopped and then restarted with a lot of adjustments, reporting those numbers. And so I think this next generation, we've got this Tanping movement, lie flat. There are a lot of people who just feel burned out. It's so competitive, it's so hyper competitive. It's starting to feel unmotivating for a lot of the young Chinese, and I feel bad for them.
Tanping.
Yes, exactly. I didn't say it well,
Lay
right,
flat.
but that's what I was trying to say. Yeah.
Right. Well, that's fascinating. So we're almost run out of time here, James. So final words as we wrap up this really fascinating conversation. So are you feeling the sunshine for 2024 in general? About the economic outlook in the U.S. For geopolitical situation, and the big question is, where is the money going in your book?
Okay, yeah. So I'm going to step back because we're just kind of a little bit bearish on China, and just reframe here. I'm actually kind of optimistic about the U.S. Stocks are not cheap. I would not be buying Magnificent Seven. Those big tech stocks. I think those are too expensive, certainly, and it's kind of just weird what a large part of the S&P they've become. But we've got a market where rates are likely to fall. The economy is, with unemployment, with inflation, it's doing pretty good. Like it's the economy everyone's loved to hate. I mean, we've been predicting a recession for ages, but it just hasn't happened. So I think we just got to look at the numbers and say the U.S. economy is on stronger footing than many of the bears would have expected. We're having a soft landing. Everyone was beating up on Jerome Powell. Everyone was beating up on the Fed, but I think he's done he did a poor job earlier of getting too much inflation. Yes, correct. Mistake made. But I think since then, he's actually done a pretty responsible job. So I'm generally bullish. If you look last year, the S&P, the regular S&P Dow was up, 25, 26%. Equal weight was up like 6%. That's because the S&P is, believe it or not, mostly a small cap index by number of stocks, but those big 7 stocks were just pulling the whole thing up, and the little small caps were left behind. We have a huge valuation gap between small caps and large caps. That might close next year. We have a big valuation gap between the S&P 500 and banks. That might also close in the year ahead. We also, and since 2011, more than 10 years, we've had a huge valuation gap between U.S. stocks and emerging market stocks. So emerging markets, banks, and small caps, I'm not saying they're going to go up a lot this year, but those are 3 areas that I'm watching, and I think there's definitely potential to make money in those.
Great conversation. Thank you so much, James. So for more insightful talks, be sure to sign up for the JJ View. Until next time.